Fourth quarter real GDP growing 2.3%. And for more on the data, the Fed's decision to hold rates steady and the ECB's rate cut this morning. Let's bring in Roger Ferguson, former Fed vice chairman and a CNBC contributor. Roger, good morning. I guess the data show still a healthy economy, maybe a little bit lighter than expected on headline real GDP, but consumption very strong, a drop in weekly jobless claims. Fed seems to look at this with the inflation still above target and say, no need to do much. How do you think about it?
I think you've got it exactly right. Chair Powell yesterday used words such as not in a hurry, wait and see. Today's data point, and it's just one data point, or set of them, really indicates exactly the same thing. As he said yesterday, the economy is healthy. That still comes through today. Consumers seem in very good shape, which is the thing that drives the economy. And the labor market seems, I think he said, pretty stable. So I think this reinforces the on-hold, wait-and-see message from yesterday.
He also said that essentially, and the committee believes this to be the case, that, the risks are roughly balanced as they look at the inflation front as well as job growth at this point. Does that make sense here? I mean, the market is always going to find maybe one leg to put more weight on in terms of what it's more focused on or concerned with at this point. We had a growth scare back in the late summer and the fall, followed by, we have an overheating economy and yields going higher in the fourth quarter and into this year. So where does it all net out?
Look, I think you're right. The market is looking for something that's going to sort of feed the lower interest rate, lower cost of capital story. The reality is inflation, which is the number one thing they should be worried about, looks like it's sort of moving sideways a bit here. And so, I think there will be a slight disconnect where, the Fed may not be able to get off, any cuts this year while the market's still pricing in some for the second half. So I think we are in a wait-and-see mode, and the market has to get its mind around the fact that, the Fed is not going to ride to its assistance by putting in more cuts necessarily. It's not resolved just yet.
The chair, tried to essentially make the case for his assertion that policy in the U.S. is still meaningfully restricted. And yet he also says, well, we don't really know what the neutral rate is. We know it by its works. He says that all the time. Well, what are the works we're looking at right now if the economy is still growing relatively strongly with Fed funds rate above 4%, with the 10-year yield above 4.5%? Are we still restrictive?
Look, I think you put your finger on one of the slight logical disconnects. And I think 2 or 3 shows ago I came on and talked about the fact that maybe we are closer to neutral than Chair Powell himself has suggested. As you point out, he says we know it by its works. Well, we've got an economy that looks like it's growing roughly at potential. We've got a labor market that looks like we're in healthy territory with an unemployment rate that used to be considered full employment. So I think there's a debate, question mark. I think we are probably closer to neutral and less restrictive maybe than Chair Powell himself has said.
And once again, the chair kind of resisted all efforts to try to get him to be more explicit about how he would deal with the potential policies coming under this administration and also to respond to the president's insistence that rates go lower. Does the Fed need to have a theory of the case, though, in terms of what the probabilities are in terms of tariffs going on, in terms of the impact of crackdown on immigration, things like that at this point? Or can they just say things are fine right now and we'll have to wait and see?
I think they have to walk a middle ground, and he suggests that they are, which is have the staffs of the various Fed banks and the Board of Governors producing various scenarios and what-ifs, giving policymakers at least something to mull over as they wait to see how things unfold. But I think he's also right. They shouldn't act on speculation. It's hard to know exactly where these tariffs are going to end up. We've seen tariffs used as a bit of international negotiating vis-a-vis Colombia, for example. So I think he's got it right. The wide range of potential outcomes. Let's make sure we've modeled or thought about different ideas, different outcomes, but no reason yet to bake anything into the policymaking process.
I recall, a couple of Jackson Hole meetings ago. Actually, I believe this might even have been pre-pandemic when Powell harkened back to the 1990s and he gave credit to the Fed at the time for allowing this productivity boom to unfold and not necessarily believe that low unemployment was going to be inflationary and all these things. Could we possibly be in another moment where we have to be at least alert to the idea that you have another productivity wave, that some of the equations are going to shift around a little bit in terms of what might cause inflation or disinflation?
I think we absolutely have to be. There's been a great deal of talk about the impact of AI on productivity. I think we're starting to see some of that already. If there's a productivity boom this time, it will be slightly different from the last one, I think. That last one was sort of slow to materialize. Fortunately, the then Chairman Alan Greenspan was very prescient in picking that up. So you're raising another really good point here. We may be at the beginning of a major productivity boom because of AI, and let's wait and see how that plays out as well.